Have you ever wondered what a checkmate looks like in the world of global finance? Not on a chessboard, but in the multi-trillion-dollar market for precious metals. There's a theory gaining incredible traction online that claims we are about to witness just that. A perfectly engineered trap set in the silver market, designed to corner one of the world's most powerful banks and potentially trigger a crisis of confidence in our entire financial system. Welcome to the Bullion Signal Podcast. I'm your host, and our mission here is to cut through the noise, examine the data, and explore the major shifts happening in the world of macroeconomics and precious metals to help you protect and grow your wealth. Today, we are doing a deep dive, deconstructing this explosive theory about a silver market perfect storm. We're going to walk through the claims step by step, not to endorse them, but to understand them. So if you're ready, let's get into it. And if you find this analysis valuable, make sure you're subscribed to the channel so you don't miss our future briefings.
The source material we're analyzing doesn't pull any punches. It opens with this incredibly provocative line. It's designed to immediately create a sense of us versus them. The implication is clear, that mainstream financial advice is not just wrong, but intentionally deceptive. This sets the stage for a narrative that isn't just about supply and demand, but about a deliberate, high-stakes game where retail investors are seen as pawns. This is the premise we're here to unpack today.
So here's our roadmap for today's breakdown. First, we'll look at the specific price prediction that kicks this whole thing off. Then, we'll dive into the core of the theory, a massive alleged silver lease involving JP Morgan. After that, we'll examine the three converging events that supposedly create the perfect storm. We'll then explore the potential consequences, the scenarios of a default. And finally, we'll cover the source's own warning and the playbook it offers to its followers.
All right, first things first, every major market theory needs a catalyst, a single event that sets the dominoes in motion. In this story, it all starts with a number, a very specific, record-shattering price for silver that, according to the source, is not the peak, but just the beginning of the real fireworks. Here it is. This is the foundational claim. The theory is built on the premise that on a specific future date, December 19th, 2025, silver futures will close at a new all-time high of $67.38. Now, in this narrative, this isn't a celebration for silver bulls. It's the trigger. It's the moment the world wakes up to a severe physical shortage, setting the stage for everything that follows.
And this slide gets to the heart of why that price matters. It highlights the alleged core vulnerability in the market, the massive disconnect between paper silver and physical silver. Think of it like a coat check at a theater. For every one physical coat they have in the back room, they've handed out almost 2.5 claim tickets. The source claims the ratio of paper claims to actual deliverable silver on the COMEX exchange hit 244%. As long as everyone is just trading the paper tickets, the system works. But this theory is about what happens when everyone shows up at once and demands their actual coat.
So if the market is this fragile, what's the spark that could light the fuse? This brings us to the central character and the central accusation in this entire drama. An enormous, allegedly secret silver lease taken out by the banking giant JP Morgan. The numbers here are just staggering. The source alleges that in October of 2025, JP Morgan was forced to lease nearly 129 million troy ounces of physical silver from a Chinese state bank. To put that in perspective, that's 4,000 metric tons. This wasn't a casual transaction, according to the theory. This was an emergency loan of physical metal to cover a desperate shortage that the rest of the market wasn't yet aware of. Now, it's really important we understand what a bullion lease is, because it's not like a normal financial loan. You can't just pay it back with cash. A bullion lease is a loan of the actual thing. If you borrow 129 million ounces of silver, you are legally obligated to go out into the global market and physically acquire 129 million ounces of silver to return to the lender. Writing a check is not an option. Physical metal must be returned.
And here's where the clock starts ticking. Every loan has a due date. The theory claims this colossal lease, this mountain of physical silver, is due to be returned in early January of 2026. This deadline is the critical element. It transforms a manageable market problem into a potential full-blown crisis, allegedly forcing one of the world's biggest banks to source an impossible amount of metal against an unforgiving deadline.
So, we have a massive physical debt coming due. That's a huge problem in itself. But the theory we're examining argues it's much, much worse. It claims that this isn't happening in a vacuum. It alleges that a perfect storm of 3 distinct events is set to converge at the exact same time, creating what the source calls an inescapable strategic trap.
And this table lays out the mechanics of that alleged trap. First, on January 1st, 2026, China is said to be implementing new export rules, effectively choking off a major source of replacement silver supply. Second, on the very same day, new global bar standards from the London Bullion Market Association would make it harder to trade silver bars from places like Russia and parts of Asia. And third, all of this is happening at a time when the Western vaults, the COMEX vaults, are already being drained of physical metal at a rate never seen before. It's a 3-pronged attack: restrict new supply, disqualify existing supply, and drain current inventory. To put a number on that vault drain, the source claims that in just the first 19 days of December 2025, nearly 62.5 million ounces of registered physical silver were pulled out of COMEX vaults. This is presented as the smoking gun, the proof that big players were already moving to secure physical metal before the trap was sprung, knowing the shortage was real and getting worse.
Now let's visualize this to understand the scale of the claim. This chart shows the percentage of the entire deliverable COMEX silver inventory that was allegedly claimed in just the first 4 trading days of December. 60%. According to this theory, that's not a leak, that's a dam breaking. It suggests a frantic rush for physical metal by those in the know.
So, if you accept the premises of this theory, the massive loan, the ticking clock, the tightening regulations, and the emptying vaults, the inevitable question is, what happens next? The source material doesn't just predict a crisis. It lays out what it describes as an impossible choice for JP Morgan, leading to a handful of dramatic potential outcomes.
This timeline really puts the squeeze into perspective. You have the secret lease in October, the frantic draining of the vaults in December, the regulatory walls slam shut on January 1st, and then, just days later, the bill for 129 million ounces of physical silver comes due. Each event is a turn of the screw, methodically increasing the pressure.
So what are the options on the table? According to this theory, there are no good ones. Option 1, try to buy 129 million ounces on the open market. In a market this tight, an order that big would cause prices to go absolutely vertical and could literally break the exchange. Option 2, try to source it from China or Russia. Well, the new rules just made that incredibly difficult, if not impossible. Option 3, default. Just admit you can't get the metal and offer to settle in cash. The problem there is that you could shatter global confidence in the entire paper silver market overnight. Or option 4, go back to the lender, hat in hand, and ask for an extension. You might get one, but you can be sure the terms would be absolutely crippling.
And this brings us to the source's ultimate conclusion, summed up in this powerful quote. The situation is not presented as a series of unfortunate market events. It's framed as a deliberate strategic checkmate. It's positioned as the inevitable, engineered moment of reckoning when the world of paper promises collides with the hard, unyielding limits of physical supply.
So after laying out this dire scenario, the source video doesn't just end there. It offers its viewers a final warning and what it calls a playbook for how to navigate the impending squeeze. Now, I'm going to present these points neutrally, simply reporting on the advice given in the material we're analyzing. For those who find this theory compelling, the primary advice given is to focus on owning real physical metal. The strategy emphasizes accumulating raw ounces. This means prioritizing common, recognizable government-minted coins like American Eagles or Canadian Maples or standard bullion bars. The key takeaway is to avoid collectible items with high markups, as the stated goal is to maximize weight, not rarity. And it urges viewers to act before this story supposedly hits the mainstream news cycle.
The source also touches on investing in mining stocks, but with a very important distinction. It recommends focusing on unhedged miners. So what does that mean? A hedged miner has already pre-sold its future silver production at a fixed price. So if the price of silver skyrockets, they don't benefit because they're locked in at a lower price. An unhedged miner, however, sells their silver at the current market price. They get the full benefit of any price explosion. So they offer more direct leverage to a rising silver price, though the source does correctly add a caution that these stocks are, by nature, very high risk and volatile.
And so that's the theory. It's a complex and dramatic narrative that weaves together record high prices, a colossal secret loan, tightening regulations, and a ticking clock to paint a picture of a silver market on the very brink of a crisis. It truly is a story about the collision between the paper market and physical reality. It leaves us with the final provocative question: is the silver market truly facing a perfect storm? It's a compelling theory, and now you have a full breakdown of how it's constructed. If you found this analysis insightful, please do me a favor and hit that subscribe button for the Bullion Signal Podcast and share this explainer with someone you think needs to see it. And as always, a final disclaimer. Please remember that the content in this podcast is for informational and educational purposes only. It is not and should not be considered financial or investment advice. You should always conduct your own thorough research and consult with a professional before making any financial decisions. Thanks for tuning in.